Picture this. You finally do the responsible thing and you start saving money. Every single month, you move a little into your savings account. $100 here, $200 there, and you feel good about it. Disciplined, mature, like you are finally getting your financial life together. But then one day you open your banking app and something stops you cold. Your savings account is sitting at $10,000 and it has earned you roughly $50 over the entire past year because the interest rate is a pathetic 0.5%. And meanwhile, everywhere you turn, people are talking about stocks and index funds and compound growth, and suddenly a very uncomfortable question starts forming in the back of your mind. Am I doing this completely wrong? Because saving money is good, saving money is necessary, but saving money alone almost never builds real wealth, and that gap between knowing you should invest and actually knowing how to start is exactly where most people get permanently stuck. Here at Cole Invests, that transition is what we help people understand. So today, we are breaking down the exact step-by-step path from saving to investing, without feeling overwhelmed, without gambling your financial security, and without needing a finance degree to follow along. Let us start with something that might feel uncomfortable to hear. Saving money alone will almost never make you wealthy. Saving is critically important, but it is not the destination. It is just the first stage of a longer journey, because savings and investments do two completely different jobs. Savings protect your money. Investments grow your money. Those are not the same thing, and treating them as the same thing is one of the most expensive financial mistakes ordinary people make. Look at the math directly. If you save $10,000 in a typical savings account earning 1% interest, after 1 year, you have $10,100. After 20 years at that same rate, you have roughly $12,200. Now take that exact same $10,000 and invest it in the stock market, which has historically returned around 10% per year on average over long periods. After 1 year, you have $11,000. After 20 years, you have approximately $67,000. Same starting amount, same 20-year timeline, completely different outcome. The gap is not small. It is the difference between $12,000 and $67,000. And that gap exists entirely because of compounding, which is the process of your returns generating their own returns year after year in a way that accelerates over time the longer you leave it alone. Here is the insight that most people never fully absorb. The biggest wealth gap in this country is not between people who spend and people who save. It is between people who save and people who invest. But the reason most people never make that transition is not mathematical. It is psychological. Saving feels safe because you can see your balance. It does not fluctuate. It does not drop 5% on a random Tuesday afternoon because of something happening overseas. Investing moves, sometimes up, sometimes sharply down, and that emotional volatility is enough to keep the majority of people parked permanently in savings accounts, watching inflation quietly eat away at everything they work to put aside. The solution is not to ignore that discomfort. It is to move from saving to investing in structured, deliberate stages rather than all at once, and that is exactly what the following steps are designed to do. The first step is building a genuine emergency fund before you invest a single dollar anywhere. 3 to 6 months of your actual living expenses, sitting in cash in a savings account, completely separate from any money you plan to invest. This is not money for opportunities. It is not money for anything other than genuine emergencies. Job loss, medical situations, major unexpected repairs. Here is the reason this step comes before everything else, and why skipping it is such a dangerous mistake. The single most common reason people panic and sell their investments at the worst possible moment is because something unexpected happened in their life, and they suddenly needed cash. An emergency fund is not just financial protection, it is psychological protection for your investments. It is what keeps you from being forced to sell during a market downturn because your car broke down. The second step is separating saving and investing mentally into two completely distinct buckets. And this sounds simple, but the psychological impact is enormous. Bucket 1 is your safety money. It does not move. It does not fluctuate. Its only job is to be there when you need it. Bucket 2 is your growth money. It is allowed to fluctuate because its entire purpose is to grow over a long period of time. When you mentally treat these as two separate things rather than one pile of money with different labels, the anxiety around watching your investments move up and down drops dramatically because you know your safety money is untouched and your growth money is simply doing its job. The third step is starting to invest with a small amount rather than waiting until you feel ready or until you have a large enough sum to feel significant. Most brokerage platforms today allow you to begin with $50 or $100. The goal at this stage is not to generate impressive returns immediately. The goal is to build the habit of investing consistently, because consistent behavior over time matters far more than the size of your initial investment or the timing of your entry into the market. The fourth step is keeping your early investments simple rather than jumping immediately into complicated strategies. The biggest mistake new investors make is moving straight from zero experience into day trading, options contracts, or speculative assets that require deep expertise to navigate without destroying capital. The simplest investment vehicle available to ordinary investors is also one of the most effective: the index fund. An index fund tracks the overall stock market, meaning instead of trying to identify which individual companies will outperform, you are investing across hundreds of companies simultaneously. Broad diversification, lower fees, long-term growth that historically mirrors the overall market. Warren Buffett, who has spent decades studying investment strategies more sophisticated than most people will ever encounter, has consistently and publicly recommended low-cost index funds for the majority of investors. When one of the most successful investors in history points at the simple option, that is worth paying attention to. The fifth and most important step is staying consistent and giving compounding the time it actually needs to work. Consider this example. If you invest $300 per month into the market and the market averages 8% annually, after 25 years, you have roughly $285,000. You personally contributed $90,000 of that. The remaining $195,000 came entirely from investment growth compounding on itself over time. You did not earn that extra money by working harder or finding a better strategy. You earned it by staying consistent and staying patient. But staying patient is where discipline becomes the deciding factor. Because markets go down, and when they do, the news cycle becomes dramatic and fear becomes contagious, and a significant portion of investors make the same mistake of selling at exactly the wrong moment. Here is the reality that long-term investors understand that short-term thinkers never do. Market downturns are not disasters for disciplined investors, they are buying opportunities. When prices drop, your consistent monthly investment purchases more shares at lower prices, which produces stronger returns when the market recovers. The investors who build real wealth are not the ones who predicted every market movement. They are the ones who stayed in the market long enough for compounding to do its work. Think of it this way. Keeping money in a savings account is like storing seeds in a sealed jar. They are protected, they are safe, but nothing is growing. Investing is like putting those seeds into soil. It looks messy at first. You do not see dramatic results immediately, and there are seasons where things look worse before they look better. But given enough time, the growth becomes something far larger than the original seeds could have suggested. Here at Cole Invests, the path we always come back to is the same one. Build your emergency fund first. Separate your safety money from your growth money mentally. Start investing small and consistently. Keep your early investments simple and low cost, and then give compounding the decades it needs to produce results that will genuinely change your financial life. Saving gives you stability. Investing gives you freedom. The earlier you build both together, the more powerful everything that follows becomes. If this helped you understand where to start, make sure you subscribe to Cole Invests and drop a comment below telling us where you currently are. Still in the saving stage, or have you already started putting money into the market? We read every single one.